very pleased to have in the studio with me Neil Irwin. He is the senior economics correspondent for the New York Times, where he writes The Upshot, a Times site for analysis of politics, economics, and more. And he's the author of the book The Alchemists, Three Central Bankers and a World on Fire, which you can see on the screen right now. And you can tweet him at Neil_Irwin, IRWIN, NEIL_Irwin, or at New York Times. And Neil, first of all, welcome. Thanks for being with us here in the studio.
Appreciate it.
Great to have you with us. You wrote a piece that caught my attention last week, as I recall, titled, Are the Bond Alarm Bells Ringing? And in this case, it was about corporate bonds, as I recall. Tell me about this.
All of the above. What's been happening in global financial markets the last few weeks, months, but really years, this has been a long time coming, is that these global markets that involve trillions of dollars, that usually are where the smart money plays and what are telling us kind of what smart money thinks is the economic future, they're flashing these tremendous alarm bells about what the future holds. They're flashing these alarm bells that suggest we're going to see much slower economic growth, maybe a recession. We're going to see low inflation for years and years to come. Central banks won't be able to raise rates for many years. And so if you take those signals at face value, we're in trouble. And this global economy is going in a very bad direction. And that all accelerated in the last few weeks. And that's having some people who really pay attention to this stuff pretty nervous about what the future holds.
Yeah, it seems to me, I actually wrote a book about this 2 years ago called The Crash of 2016 that suggests that really the crash of 28 has never gone away, and that we're just trying to hold this back because we haven't done the structural reforms. We haven't brought back Glass-Steagall. We haven't put the banksters back in a box. We haven't definancialized our economy. We're still shifting away from a manufacturing economy. There's all these things that are not good for a nation our size that have not been resolved. And it seems to me like, you know, negative interest rates, for example, and quantitative easing are symptoms of, you know, more bubble gum, more baling wire up against the dam, to mangle and mix metaphors. Do you think that that's a reasonable analysis?
Yeah, I think there's something to that. What we've seen over and over is this process where the economy disappoints, we have a giant recession, and the only game in town to deal with it has been central banks. So they cut interest rates, they do QE, they buy all these bonds, they do all these things to try and push interest rates lower, which in normal times is pretty effective at keeping the economy on an even keel. But the problem and the economic problems we've been facing are much more severe than those tools are really good at. So we have this very distorted economy right now where, you know, we have all this money flooding into investments and driving up asset prices, driving up real estate, driving up the stock market. The stock market's been in new highs lately. But that's been disconnected from what's happening in the real economy and the kind of real economic growth we're seeing in terms of people having incomes, people having jobs, industries being able to invest and expand. That has not caught up nearly as much with where financial markets are. And that's because we've had this unbalanced economy where Congress and fiscal policy in the U.S. and around the world really has been sitting on its hands, not doing much of anything, not doing anything to get industries growing, to get money in people's hands. And the entire weight of the recovery has been on the Fed and other central banks, which has created this distorted situation with asset markets.
Right. And a way that an economist would describe this is to say that we have been relying on monetary policy rather than fiscal policy. We've been meddling with the money supply and where the money is flowing rather than trying to, well, what FDR did, for example, you know, rebuild the country. What Eisenhower did, I mean, you know, we came out of World War II at 127% of GDP in terms of debt. That was the highest debt we've ever had in the history of the United States. And how did we get out of that? We borrowed more money and built the interstate highway system. We grew our way out of that. You know, we had 4% annual growth of GDP throughout most of the late 40s, the 50s, the 60s, and the 70s. We had 3 decades where we never went below 3% annual GDP growth. And it was because we were investing in fiscal policy, we were, or the real economy, let's say. You know, we were creating jobs, we were building industry. Now we're moving money around and we're supporting banksters.
Well, and you know, the truth is,
feel free to push back.
I agree with a lot of that. So what's happened? So we have extremely low interest rates right now. That's a sign that investors around the world are fleeing money at the U.S. government, at U.S. companies, saying, here's money on cheap, easy terms. U.S. Treasury bonds, 1.5%. That's free money, basically. Right. Congress could step up and say, you know, we're going to take advantage of that and make investments that will make the U.S. economy more prosperous in the long run. That involves infrastructure, that involves education and worker training, that involves all kinds of things to make sure our economic potential grows and that we get out of this mess. And the time is right to do it because the money's cheap. That's what, you know, and that's to the credit of the Fed and these central banks. They've made sure that money's cheap. They've made that possible. But we're not doing it. Congress is not really doing much of anything.
Isn't that the essence of, I forget whether it was Janet Yellen or the head of the ECB gave a speech about a year ago saying basically we're having to do this because legislatures are not stepping up and making the investments in their countries that you're talking about.
Yeah, I would tend to defend Ben Bernanke and now Janet Yellen in having these easy money policies because it's better than the alternative, right? You want, when there's a recession, you want your central bank to try and flood the economy with money and try and get things going.
The Fed did the opposite in 1929. It didn't help.
It ends very badly. Yeah. But the problem is what you also need is when, you know, they have these very blunt instruments. They can print more money or print less money. And those, when they do that, it has more effect on stock prices, asset prices than it does on incomes for ordinary people. Only Congress can actually spend money. So you need the elected officials, you need governments to say, we're going to take advantage of these low interest rates to put money into people's pockets, to build infrastructure, to build long-term possibilities.
Right. Now you are a reporter. You're the senior economics correspondent for the New York Times. So I'm assuming that in the course of your reporting, you try to be relatively nonpartisan. I'm a political commentator. I do partisan for a living. If I may, respectfully, it seems to me like what you're saying, what Bernie Sanders and Hillary Clinton have been saying for some time, and what the Republican Party has been largely ignoring. Is that a reasonable assessment? And feel free to say you don't want to get into politics, but it's like we're having a debate in this country that doesn't seem to be well informed.
Yeah, and it's what's frustrating about it. It's not even a purely ideological, theoretical debate. If you talk to, you know, thoughtful conservative economists who, you know, are not partisan, but lean conservative, lean libertarian, a lot of them will even acknowledge that, you know, yes, in this era of, you know, relatively, you know, weak employment situation and very low interest rates, it does make sense to build more highways, to build more infrastructure. The problem is when you get from that kind of conceptual, theoretical world to the actual partisan political world. And it's absolutely true that Republicans in Congress, they run both houses of Congress now, do not want to move in this direction of doing more infrastructure, spending money on things that might take advantage of lower.
There's another piece of our infrastructure that it never gets lumped into infrastructure, and I think it's the most critical piece, and that's our intellectual infrastructure, which is our young people going to college. And, you know, we know from the GI Bill, the experience of the GI Bill, for every dollar we invested in educating people from my father's generation, we got $7 back in additional tax revenue as a result of their, you know, increased earning capacity with a college degree. Isn't that something that we should be looking at, too?
I think so. I mean, you know, clearly this is a 21st century economy where a high school degree alone doesn't cut it anymore. I mean, in some cases, even a college degree doesn't cut it for certain kinds of industries and fields. Sometimes you need a graduate degree. Certainly, you know, getting a community college or kind of technical training beyond high school is just essential if you want any hope of a middle-class income in this 21st century economy. So to do everything we can to make sure that everyone has the ability to get that additional training and you know, really be available and qualified for the jobs that the modern economy is creating, that's tremendously important. And so it's you're right. It's not just roads and bridges.
Yeah, it seems like common sense, you know. And then of course the information infrastructure as well. You know, South Korea has, you know, the fastest internet speeds in the world. You know, they've really paid attention to that part of the commons, and it seems like we've failed to, or we've privatized it.
Yeah, you know, we talk about roads and bridges when we say infrastructure. Really, it's a much broader concept. There's a lot of stuff you don't see that's really important to, you know, making sure that different cities, that their water supplies are well taken care of.
Right.
It's all kinds of things that, you know, there's no excuse when interest rates are 1%. When you know, we have things that are pretty clear value for people, we don't do some of it.
Yeah, I'm with you. Neil Irwin, senior economics correspondent with the New York Times, author of The Alchemists. Neil, thank you so much for being with us.
Thanks for having me.
Great having you. We'll be back.
To watch more clips from our programs, hit the Watch More Videos button over here. And please be sure to hit the handy-dandy subscribe button so you'll always be up to date. Tag, you're it.